I teach high school, which means I explain things to idiots every day. If you still don't understand call options, I got you. I see a lot of people asking basic questions about calls on just about every thread that mentions them. So here you go. Note, before the finance majors come out and nitpick small things, remember that this is a basic primer for idiots. Some of it has been simplified. What is a call option? Basics. A call option, hereafter referred to simply as a call, is a contract that gives you the ability, though not the obligation, to buy 100 shares of a stock for a specific price by a specific date, called the expiration date. Example, you buy a $400 call for GME that expires on March 19th. What that means is that at any time between now and end of day on March 19th, you can buy 100 shares of GME for $400. If the price spikes to $700, you can still buy them for $400. That's a pretty good deal. So I need the price of GME to get to $400 to break even, and anything above that is profit, right? Not quite. You have to pay a premium for the option, which is the amount of money you're giving to the option seller in exchange for the contract. The premium is listed as the price per share, so if the option has a $2 premium, that means that you have to pay $2 per share of GME in the contract, which means that you pay $200 to buy the call, $2/share x 100 shares. You give the seller $200, and they give you the call option. Since you paid $200 for the option, this means that your break-even price is $402 per share. Why? Because if the price only got to $400, you could have bought it for $400/share without buying the contract, which means the money you spend on the contract was a waste. However, if the price goes to $403/share, then you make a profit, because you effectively paid $402/share for a stock worth $403/share. But what if the price doesn't go up, or even goes down? Do I have to still buy those shares for $400? No. You never have to buy the shares if you don't want to. Remember, a call gives you the ability to buy shares for $400, but not the obligation. But what if the price of GME goes way up but I don't have $40,000 around to buy 100 shares at $400/share? Then you sell the contract to someone who either does have $40,000 sitting around, or, slightly advanced info here that you don't need to know, to someone who is trying to offset a position. Regardless of who buys it, they will pay you a lot of money for your option because it is ITM, or in the money. What does that mean? Let's look at some option vocabulary. Call option vocabulary. Strike price. This is the price that you are allowed to pay for the stock for the contract. In our $400 call option above, the strike price is $400. At any time before the expiration date, you are allowed to exercise the contract and pay $400/share for the stock. Exercising an option means you are exercising your ability to buy the 100 shares of stock. In the example above, you would spend $40,000 for 100 shares of stock regardless of the stock's price at the time. Can I exercise and only buy 20 shares of stock? No. If you can't afford to exercise, then you can sell your option to someone else. Expiration date. This is when your call expires. If you have a 3/19 expiration date, that means that your call option is no longer good after 3/19. Premium. The premium is the price you pay to the call seller for the contract, and it is listed as the price per share. Knowing that, how much will it cost to buy an option with a premium of 0.25? If you do the math, it will cost you $25, which is 0.25/share x 100 shares. ITM and OTM, in the money, and out of the money. ITM calls are calls for which the stock price has exceeded the strike price. If you have a $400 call, and the price of GME goes to $405, then your call is ITM because you can buy a $405 stock for $400. If you then immediately sold the stock for $405, you'd make money. OTM calls are calls for which the stock price is below the strike price. If you have a $400 call and the price of GME is $350, then your call is OTM. It is important to realize that being ITM doesn't mean being profitable. In the example above of the $400 call with a $2 premium, if GME goes to $401, you are ITM because $400, but you haven't broken even yet because your break-even price is $402. FDs. FD is not an investment term, and you don't need to know what it means in order to understand calls. It is a WSB term, and it stands for Maggots Delight, but with an F, because Ahmed won't let me define FDs. FDs are OTM calls with short expirations, and as such are a huge gamble. Those were all FDs, and they all expired worthless. Why are they called FDs? Because when you buy FDs, you usually end up taking it in the ass. When people list their option positions, they use a bunch of numbers and letters that I don't understand. How do I figure out what they're talking about? You have probably seen something like this: GME $400C319. Let's break it down. GME $400C319, the GME stands for GameStop, which you probably figured out. The $400C is a call option with a strike price of $400. If it said $400P, it would be a put option, but we'll talk about those later. The 319 stands for the expiration date. Now let's make it more complicated. If I said, I bought 10 $5 GME $800C319, what do I mean? It means that I bought 10 contracts of GME $800 calls with a 319 expiration, and I paid $5 per share. If I paid $5 per share, how much did I spend on my contracts? I spent $5,000, $5/share x 100 shares x 10 contracts. Now you try it. A $700 call on GME that expires next week costs around $7 a share. How would you explain to me that you bought 2 of them? You would say that you bought 2 $7 GME $700C319. Now you can look like you know what you're talking about even though you still probably don't. Why do people buy call options? This is confusing. Why do people even do this? People buy call options because you can make a lot of money. If you have the right to buy 100 shares of something for a fixed price, then for every $1 the share price goes above your break-even price, you make $100. If you have a $400C with a break-even of $402, and the price gets to $412, then you make $1,000 profit. That's $10 of profit, $412 $402, times 100 shares. You can buy the shares and hold them, or you can buy them and sell them immediately to realize that profit. Or you can sell the contract to someone else and just take the money. It is usually better to sell the contract, but that's not an important distinction because most of you can't afford to exercise anyway, and will be selling contracts. Why are calls dangerous? When you buy a stock, at least you own the stock. If you buy an option and it expires worthless, then you have nothing. If the guy who bought 90K worth of FDs had bought 90K worth of GME and held, then he'd still have somewhere around 90K worth of GME +/5%, depending on when he bought on Thursday. Instead, he has nothing. Why does the value of my call keep changing? So you bought a call option, and every time you look at it it's worth a different amount of money. That's because there are actually 2 types of value in an option. Options have intrinsic value, and extrinsic value. Intrinsic value is the exercisable value of the option. If you own a $400C, and the price is $412, then the intrinsic value of the option is $12/share, or $1,200, because that's the value you would get if you exercised it right now. As stock price goes up, intrinsic value goes up. Pretty easy. Extrinsic value has a more complicated definition, so we're going to call extrinsic value the potential the option has, and that potential is based on time and volatility. For example, if there is a long time before expiration, then that means that there is more potential for the option to go ITM, because more time equals more chances for the price to rise. Therefore, options further from expiration will be worth more than options close to expiration. Conversely, less time to expiration equals less value, which means that your option can constantly lose value as time goes on and the number of chances you have to go ITM decreases. This is called theta decay, but you don't need to worry about that. Volatility is the second part of extrinsic value, and options for stocks that are more volatile can be worth more than options for stocks that trade steadily, because if a stock price swings wildly up and down, there's a greater chance that one of those upswings will put you ITM. This is reflected in a measurement called FOR, or implied volatility. Like theta decay, FOR is a more advanced concept that you don't need to understand now as long as you get the basics. Due to the factors of time, theta, and volatility, FOR, constantly changing, the extrinsic value of your option will also change over time. This is why the value of your option will constantly change. Is the stock calming down and starting to trade sideways, low volatility? Your option value will decrease as 4 drops. Is the stock starting to jump around? Your option value will increase as 4 increases. Sometimes the stock price can be climbing slowly, but the value of your option can be decreasing. Why do you think that is? If the stock value is increasing slowly, but you're way OTM and running out of time because your option expires tomorrow, the downward price pressure of theta decay can overcome the upward price pressure of volatility and stock price rise, and your option value can decrease. I bought a call and I'm ITM. How/when do I sell my contracts? You can sell your contracts at any time. You don't have to wait until the expiration to sell your contracts. This is good, because if the price spikes, you can dump your options for profit and move on. There was a point yesterday when 90K FD guys 275 and 285 calls were ITM when GME spiked to 290. If he had sold then, he wouldn't have lost everything by waiting until expiration. I bought a call and I'm ITM. How/when do I exercise my contracts? Make sure that you have enough money to cover buying all the shares and click the exercise button. They get your money, and you get their shares. This can take some time. Okay. I get it. But can you give me a TLR just in case I actually don't get it? A call option is a contract to buy 100 shares of a stock at a certain price. To buy the contract, you pay a premium to the contract seller. If the price of the stock goes above the price of your contract, you can either buy the shares or sell the contract for profit. The end. So I'm an expert now and can go YOLO everything on calls and make money? No. You have a basic understanding of how calls work and know just enough to be dangerous. Don't go crazy. Buy a call. See how it works for real. Don't YOLO your life savings on your newfound knowledge. Or do. Live your life how you want. I'm not your dad. Just make sure you post the porn when you win or lose. Web link. That's actually explained in a way that some apes might understand some parts of it. Impressive. Imagine being me, studying finance at a good university and being taught deep knowledge on options, futures, etc., taught how to derive them, calculate the fair price, taught various different complex models, etc., and I spent all that time partying, finding out where I would get high with friends on that particular night, and where we would meet the most girls. If only I paid attention. Somehow I still passed the year laughing my butt off. At least I still have access to the content so I can go through it again. 40% of biology students who graduate from Ivy League schools end up going into finance. I think the reason why they hire people with that degree is that they know A, no one is actually effing studying finance in undergrad anyways, so all that matters is you're willing to learn later, B, biology majors are clearly willing to read and read and read, and C, they're used to doing it with significantly less cocaine involved, so that's a real bargain. I went to art school, so I'm good at partying. Can I get a job in finance now? Probably. A friend of mine visited his friend at art school. Her roommates had a communal vibrator. They certainly sounded like WSB material to me. Hey, I saw that episode of Blue Mountain State. They all get herpes from passing around a pocket cat. This was the old line state, but I'd hate to be their OB/gins. Art school is basically a call option on student debt. As an art school dropout, that's fair. Make some NFTs, sell them to idiots and become a billionaire in the next 3 years, that's what I would do. Don't mean to be insulting, try to pardon my ignorance, but the NFTs gimmick seems like a joke to me. Who would pay $60 million for a JPEG file? People who want to launder money. To launder their money. It's just a speculative market around digital certificates of authenticity. Art world now, the NBA is using them to back a speculative market around digital trading cards. I'm sure game DLC like skins and card packs will follow easily. I'm sure it'll evolve into representing real-world assets, deeds, etc., as more U.S. states consider smart contracts and blockchain transactions as legally binding. Biology major here. The money I made in the past month investing is more money than I made doing my actual job. After doing this whole biology thing for close to a decade now, I'm looking at finance a little differently. I also talked with those meatheads in the School of Business at parties. I would bet on the scientists out researching the business majors 9 out of 10 times. And if finances is just doing research and then profiting. I'm in. Maybe another biologist turning to finance. My thoughts exactly. Always looked down on the business majors I knew when I was in undergrad for not contributing anything to society and having an IQ 3 below plant life. But crap, research doesn't pay the bills. I want to get good at this and also stay in my field. I would also like an official Red Ryder carbine action 200-shot range model air rifle. You'll shoot your eye out, retard. Glad to hear you've had some success. Read about Jim Simons, one of the most successful traders of all time. He hired scientists, not finance people. Or they hire them because it's an Ivy League degree? Lol. Probably a bit of both. I studied English literature at a third-rate state school and I work in banking compliance, and I'm better at my job than the MBAs I work with because my reading comprehension is major league comparatively, and I do zero cocaine, so this checks out to me. I actually find that biological/ethological models are eerily similar to finance math. I mean, we are apes, right? And they have been invaluable to me in playing my brokerage account. Biology majors now often require at least basic calculus, quite a bit of physics, and chemistry, all of which I have found use for in my stock adventures. Michael Burry and Jordan Belfort both were in the biological sciences, as I hope to be more like Burry than Belfort. To be fair, what made Belfort successful was his sales ability. Burry takes a more methodical and scientific approach to investing. I have no sales ability. I couldn't sell tequila shots to a manic undergrad on spring break who was going through the DTs. We are also taught really complicated probability/statistics because that's how molecular biology functions in nature. It is a game of rigged chance whether or not oxygen gets in our blood when we breathe. I actually went to college for anthropology and never even completed. I worked my way up and actually ended up taking over a micro lab, then became an applications and formulation scientist. Now I'm in regulatory affairs. All with no degree whatsoever. My girlfriend just finished going through Z, Series 66 and takes her Series 7 exam next week. She gave me all her textbooks and so now I'm studying to go through Z and Series 66. Once I'm finished and pass the exams I may look into changing industries. But I don't know how much luck I'll have without a degree. I had to work my way up to get to where I'm at now. Not sure if I'm willing to start at the bottom once again. I'd say you've shown a remarkable capacity for reinvention thus far. See, that's the thing. You can always relearn the material. But can you spend all your time now partying, getting high, and finding chicks to bang? Maybe, maybe not. Sounds like you had your priorities straight, gorilla, monkey. Agree. LOL, I also studied finance but over 20 years ago and I didn't remember much. Never really got into the stock market. I'm definitely learning more now that I'm actually losing money. Hey, that doesn't sound like a bad year either way. The real move is getting high than studying Black-Scholes options pricing models. It gives me a much greater base with which to learn the real technicalities with a reasonable broad understanding. I'm good at taking a simple understanding and expanding it with technical information. Just starting with the more technical information without that is way more work to ensure you're understanding it properly. Thank you for watching. Please subscribe to be the first to know about Red Rabbit Reader's new videos. If you like our videos, please like them on YouTube and share them with your friends. We welcome your comments below. Press to start another of our videos.